Hi, everybody. Jeff Yastine here, and welcome to another edition of Market Insight for Monday, April 13th here. And I'm joined by my friend and colleague, Brian Christopher. And Brian, how you doing today?
Well, doing well, Jeff. Thanks. It's great to talk to you again.
Yeah, absolutely. It's great to have you back on while Ian's off for another handful of days here. And Brian, let's talk about the market here. This morning, Monday morning, the market has sold off somewhat. It's not nearly to the degree that we kind of got used to seeing back in March, but it has sold off. What's your sense about where the market is now regarding are we past the lows in your opinion? And this is a sort of a viable entry point as some on Wall Street are beginning to indicate, or are you still somewhat reluctant to buy anything in a big way here?
Yeah, I think we still need to be cautious, but the recent market activity has been constructive. You know, we bottomed on March 23rd. The market, we're up, 25% from those levels. We've almost retraced the full half of that loss that we had from February 19th to March 23rd. So that is good, but at the same time, I don't expect markets to go up in a straight line. So some kind of pullbacks like we're seeing today, it's normal. It's not necessarily anything to be super worried about, but at the same time, I don't think we need to go all in right now.
Yeah, and I would echo that as well. My view, and this is what I've been telling my subscribers, is you can buy stocks here. You should be able to buy stocks in any environment. It's just that you shouldn't expect them to go straight up, as I think a lot of us kind of got into the bad mental habit of thinking, yeah, I buy the stock and if it goes up, that's good. And quite often, stocks go through this sort of, baking period, since a lot of people are baking these days during the lockdown. You buy a stock and it bakes for a while until it moves higher. And that might be 2 months, 3 months, 6 months later. But the main thing is to buy it when it's at a good value. The one thing I will say, there are a couple of things. One is back in March, Goldman Sachs had said that they didn't think the stock market would bottom until it hit 2,000 for the S&P 500. And as you know, the S&P fell to around 2,250 or so.
That's right.
Before it rebounded to what we're seeing today. Over the weekend, Goldman Sachs came out and said now they think that the market has actually bottomed, where we hit in late March, and will not have to go down to 2,000 for the S&P in order to fully reflect all the uncertainties and the potential recessionary environment that the U.S. economy faces these days. And in their view, there's just so much stimulus coming out of Washington with all these different stimulus programs, as well as the Federal Reserve having cut interest rates to zero, and they have all these other programs to continue to provide liquidity for all these different sort of secondary debt markets. They just feel like there's so much out there that basically supports the economy in such a way to get us through this period. So I'd sort of take a middle road on that. My view is, be wary. You need to be someone who is a buyer, not for this week or next month, but for 6 months and a year down the road. And you have to have that view in mind. Maybe buy less now and buy more later when you feel like the market really has bottomed. But the other thing is, it's possible we don't revisit those lows from March because there is just so much support out there now. The other thing I'll say, I'm sorry to suck up all the oxygen on this, but the other thing I'll say is, Wall Street's about narratives. And, the narrative for, the last 5 weeks before we bottomed was about this, the COVID-19 virus. Then it was about the recovery, or at least a rebound. And we're getting that now. Now we're headed into the first quarter earnings season, and that will be yet another narrative that will unfold. And we could see the earnings season basically come out not as horrible as Wall Street expected. In that case, there might still be more moves higher ahead for the indexes. Or on the other hand, again, it could be a very treacherous environment if analysts decide, we need to cut our estimates for the coming quarters and for the year. and maybe the S&P 500 has to move lower in order to reflect that. So I don't know, Brian, if you can tee off on any of that kind of rings a bell for you.
Yeah, I think with respect to that narrative, also don't forget that Washington, D.C. has gone through concerted efforts to make its own narrative, which is whatever happens, we will support you, both with respect to the Federal Reserve and Congress, who we've been told and believe will have more stimulus efforts to help put a floor under this market, to help support this market. I think that's another bullish factor that we've seen so much stimulus already. To some extent, it's like there is more coming, but for sure there will be with any kind of a concerted pullback.
Yeah, I agree. And one thing else I'll point out. We saw this in 2008, 2009, as the market went into its final bottom in March of 2009. A lot of the better quality stocks, they had an initial bounce in like late 2008, and they never actually hit new lows, even though the overall S&P 500 did hit a series of new lows going into March of 2009. And so that's something else to think about, because a lot of us, will sit there and look at individual stocks to buy. And we have to keep in mind that that individual stock may have much better earnings quality or better growth than the overall indexes. And if it does, the way it trades is not going to be the same as the overall market. And that's why, let's talk about Disney here, because I think Disney is a very interesting company to be looking at in this environment. There's a lot of things that say don't buy it because of the COVID-19 and the effect on the theme parks and the Disney Cruise Line. On the other hand, it may not. I think it hit about 80 or 81, and it's roughly 100 or so, 99 today. It's another example of a stock that may not get back all the way down to 80 or 81. And so, for anybody who's listening to it, that's something to think about. Individual stocks, the better ones, don't trade the same as the overall indexes. So the S&P could make another, marginal new low for all we know compared to where it bottomed out in March. Doesn't mean that the favorite stock you were watching is going to be the same. I don't know, Brian, any thoughts there on that one?
Well, you had that Disney situation is interesting. You had Bob Iger retire literally a day or two after they had to shut down their park in Shanghai. And then I said to myself, maybe it was just enough. It's time to go. I've led this company to the greenest of pastures, and yes, it's an issue. And I don't know. I maybe he didn't say this, but it's like it's time to go, right? But now it's time to come back. He's the right person to lead them through this, and so for Disney shareholders and prospective Disney shareholders, this is a good thing. I mean, if he can just put his retirement off for another 6 months or insert number here, I think they will be much more well off in the end.
Yeah, I agree. And it is interesting because I remember reading stories when he retired, and then the effect of COVID-19, hit us in March. And some of these stories were sort of almost spinning the opposite. It was like Bob Iger retired because he knew COVID-19 was coming. He could see it from the sort of Disney intelligence from its parks in Asia, and wanted to basically go ahead and exit stage right. And maybe that was true, but maybe when they realized the impact on the overall company, it's like he had to come back as the sort of the star quarterback to kind of lead the team to one more touchdown. I think it's the right move. I mean, I get the sense you would agree with that.
I do, and then and we'll see what the effects are going forward, right? In terms of how much social distancing remains with us in our normal activities, which certainly would reduce some of the people that come through those parks. At the same time, this is a diversified company, so there's a bunch of people who are sitting in their house watching Disney Plus, and probably a lot more watching Disney Plus today than 2 months ago because they were able to sell a lot more subscriptions. So
yeah, Disney Plus has been, sorry, I didn't mean to cut you off there, but Disney Plus has been setting records for Disney in terms of, they projected a certain number of subscription levels, up to a certain point, and they've blown past all of that. And they've really expedited the launch of Disney Plus in places like Europe, where there's a lot of lockdowns going on as well. in part because they knew, this is a great time to introduce this service to people while they, just can't get away from their screen. So there's a lot to speak of positively for Disney. Brian, any final words here? Because I think this is probably a good spot to wrap things up.
Yeah, I just think Disney is a great example of a company that people might want to think about. Maybe it doesn't go all the way back to the lows, but maybe if it falls a little bit further and you're able to buy it for 25, 30% less than its peak, great blue chip names like that, always be on the lookout for a temporary sale in those, because that's just, it's going to pay off long term.
Absolutely. I think the old sayings that we kind of rely upon sometimes in the stock market really are true in this case, in terms of nobody ever buys an ultimate bottom. And I know people, and I think we all kind of fall in that camp. There are stocks that we told ourselves back in 2008, 2009, and before that, 2003, when the tech bubble burst and had bottomed out around then. And back in the 90s even, we said I wanted to buy that stock, and gee, why didn't we ever buy that one, And so you don't want to have that happen this time around, because, whether the S&P falls like it did 35, 38%, or it falls further, doesn't mean that your favorite stock is going to do the same. Brian, thank you very much for coming on to Market Insight this week.
You bet. Thank you, Jeff. Thanks for having me.
And for all of us, I'm Jeff Yastine, and wishing you the best of goodbyes. We'll be back again next week with another Market Insight.